up from 06 to 08, then all the way back down to 04. I mean, this is horrible volatility. So you have to be able to laugh about losing a couple of $1,000 or don't even think about playing gasoline. But I'm planning on laughing about making $2,000 because I really feel into the holiday this is a good play. I just do feel that's a good idea. All right, so now let's get to a few questions. Wayne says, at what price point would you roll to SDS June 20 calls bought at 73, now 50? Oh, in the short-term portfolio? What do we have? I think you're right about that. Let's see. SDS. Okay, yeah. The June 20 calls bought at 73. Wow, you got a better price than we did. How did I do? How come I got such a shitty price? Now 50. That's about right. And at what point would we roll them? You're right. This is almost the point. I mean, when you're 20% down. Okay, first of all, why did we do 100? Did we really do 100? That seems like so much. It seems wrong. Hang on a second. I got to check that. This seems like I added too many. Why would I add back 100 like that? I'm mad at myself if I did. That's a little too aggressive. I think it's a mistake, though. I think it should have been 50. I hope it should have been 50. That's really bad. Also, that's in 5-1. There's something seriously wrong with this. Or did we already double down? SDS, I think we have to go with doubling down. Oh, we did double down. And we never got out. Wow, I'm not happy about that at all. Okay. Sorry, my bad. That's not good. So here, SDS, we're talking about the June 20 calls that were in the short-term portfolio. We had originally bought them for, oh, I see. Oh, I know what happened. We did get out. We bought them. We made a profit. We lowered our net to 75. I know what it was. We made a profit. We lowered our net to 75, but in the machine it doesn't show that. It only shows it showed a higher price, like 90. Then we bought more at 75. And that was our last round. The second round was at 75. Now I know what happened. So in other words, we doubled down previously. It went up. We sold at 115. I remember what it was now. We sold at 115. That was a small profit. Like I think our average was maybe $1, and we sold at 115. So we had 15 cents in our belts. That dropped our net basis to 75 on the ones that remained. But on the screen, it showed 90 because the profit went to cash in the portfolio. So these showed 50 were left at 90. Then when it went back down to 75, we doubled down again because that had been a good point to buy in. And that dropped our average basis, not on the whole transaction, but on what was left. The average basis was 81. Since then, though, it has not gone well. That happened on the 12th. So now I understand what, now I'm back on track with this trade. So if we zoom out on this guy, we get to the 12th? Yeah, there we go, the 12th. Okay, so we took advantage on the 12th of something, and we thought we went up to 2100 again. We thought it would come down, but it never really did. And here we are at 2127 with no help. Now, obviously, though, the S&P is volatile enough where it's very, very easy for us to get back to this, for us to come back down below 2100. But the question is very valid because now we're down about 20%. When you're down about 20%, you got to start looking at what your options are. But usually, you don't want to get do anything too crazy unless you're down like more than 20%, like closer to 40%. You want to take a move if you're planning on sticking with something. I mean, 20% though, if you don't like your options, then you get out. So we have the June 20 calls, right? Yeah, we have the June 20 calls. They're 50 cents. Rolling them doesn't make sense because, first of all, if you roll them to the 19s, we're at 19, so actually it's not a bad play. Take it back. If you roll to the 19s are $1. So if we spend 50 cents to roll down $1, that's obviously a good deal, especially because that $1 is in the money. But we need to be really sure that we're very confident that we're going to hit our time frame, that the S&P will in fact go above 20, so we get our money back. Well, we won't get our money back because we spent 80 cents. We'd actually, we need to be over 20.30 if we were going to do that, because we'll be up to about $1.30 in the on the trade. So you have to be very confident that you're going to hit your time frame. Otherwise, why are you doing it? And the other thing is, of course, you also have to want to spend the money, because it's not an insubstantial amount of money. It's $5,000 to do the roll. So we kind of look to see if we can possibly avoid that. And what if we sold the 20 puts? I'm sorry, the 20 calls. If we sold the 20 calls to somebody else for 50 cents, and then we use that 50 cents to roll ourselves to, I would go to September. Let's say the September 19s. These are $1.50. All right. So if we invest $1 in rolling ourselves, or $1.05, if we invest $1 to roll ourselves to the September 19th, then we sell the June 20s to somebody else. And the June 20s are out of the money. They're the ones that we have now. What are we doing? We're flipping ourselves into a position for a net spend of 50 cents. We're dropping ourselves $1 into the money. We're buying ourselves 3 more months for the call to go our way, for the position to go our way. And we're setting ourselves up to have an income stream, because if the June ones, if it stays low in June, those will expire worthless. Then we sell something else for 50 cents in July. Then we sell something else 50 cents in August. So we can hopefully collect a lot of the money back. And if not, we can also roll ourselves lower if we have to. So the bottom line is that's what we can do. I don't want to do that yet because I'm not sure that the S&P is going to stay this high. At a point where I kind of give up on my position, where, like, if the S&P stays up today, even after all the hassles it's going through this morning, if the S&P stays up today and we're still up tomorrow morning, I'm going to be kind of inclined to do this roll. So what we're going to be doing is changing our position into a spread. And what's our net spend? Our net spend is we spent, I'll go back to this. We spent 80 cents to be here. We have to spend, it's down to 50. We have to spend $1 more to get to the September 19th. So that makes $1.80, right? Less than we're going to sell for 50 cents the same positions we currently have. And that makes a net $1.30. And let's remember, though, that we have a $1 advantage on our caller, right? So even if the S&P, even if SDS goes over 20, we still have a $1 advantage on the caller, and theoretically we're going to be able to roll them. In fact, if you look, what you do to look at that is what July position is 50 cents. Well, the July 21's at 50 cents. So if we can roll our June 20s up to the July 21s, that gives us a $2 spread. So if it starts going our way and we decide to roll the short callers, that's fine, because we're rolling into a $2 spread, and the only reason we would do that roll is because it's going our way. All right, so that's it. So in other words, I like all the things we can do. I like that better. Now notice we have a ton of possibilities for what we can do by looking at that spread. The June to roll down into June, that gives us no extra possibilities, does it? All it does is we roll down and cross our fingers that the S&P goes up. I'm sorry, that SDS goes up and the S&P goes down. So we could spend our money here, roll down and cross our fingers, and that's not very attractive, right? Or we can proactively move to a longer-term hedge that gives us a potential income stream and sets us up in a much better position longer term. All right. So since I love those choices on the longer roll, that's what we're going to look at. And the only thing we care about now. So now that I'm comfortable with that, the only thing I'm going to be worried about is whether the net of that spread goes against us. So in other words, if the S&P goes higher and SDF drops further, and instead of costing us, how much are we going to spend net on this roll? We're going to spend net 50 cents to do this roll. If the net goes to 60 cents, we'll start feeling some pressure to get it done. If the net goes to 40 cents, we'll be like, oh, great, obviously things are going our way, it's getting cheaper. So the only time we're going to be worried now that we feel pressure to execute this roll that we know we want to do is if the roll price starts going against us. So now we're going to start keeping track of that roll price and making sure we don't spend more than like 60 cents to accomplish the roll. And that's it. So I hope that wasn't too totally confusing, but that's my logic in saying, yes, that's what I want to do. I don't want, so my answer, the quick answer to Wayne, if we were in chat, would be like, no, I don't want to do that yet. But since we are doing the seminar, I'm explaining my whole thought process here. So when I give you like an answer in chat that says no, I don't think it's a good time to do that, that's what my real answer is. My real answer is because I see this and I see that and I think about that and I'll wait till this and then we'll see what happens there. That's a better choice for me than the other. It's kind of like in chess, right, where the guy says, move your knight over there. It's because of 100 other things, but the only thing I have to actually tell you is move your knight over there. So in this case, that's why I feel like it's better to wait. We can give it another day or two, keep an eye on the net of that spread, and I've already decided that I would rather roll back than roll down. All right. Does look like a strong market, and I agree. That's exactly why. Jal says, what exactly are the CVs afraid of and why so much intervention if everything is good? Well, it's not good. That's what I'm saying. We were just talking about that in chat. For those of you who weren't in chat, let's see. So for those of you that weren't in chat, what was I saying about fire? I know I said something about it. There you go. Okay, so we were talking about the central bank thing, and I said that this is what I'm looking at. See, here's the VIX, and the volatility went up, and it was crushed. And in the morning, the volatility is up because of the news, and people are worried, and then it gets crushed. And then in the morning, the volatility goes up, and it's crushed again. All right, this is because of this intervention going on here. This is because people are driving the market. They're not allowing it to go down. And as Jal says, what are they so afraid of? What is this about? And I'm saying here, this action scares the crap out of me because it indicates that they, which in this case would be the central bankers, the government leaders, all the people who are talking the market up, including Blackstone, because if you look on Yahoo Finance and you go to, and I'm randomly saying, I'm just picking big companies. So we go to Exxon and we look for major holders. I'm sorry, Blackstone, BlackRock. Here's BlackRock, okay? And who else are you going to see? State Street, Bank of New York, Northern Trust, Wellington, BlackRock again, JP Morgan, Bank of America, right? Now, let's go to Citibank. Who owns them? State Street, BlackRock, Invesco, Wellington, JP Morgan, Bank of New York, Northern Trust. Let's go to IBM. Who owns them? Berkshire. All right, State Street, BlackRock, Bank of New York, Northern Trust, BlackRock again. You get it? Apple. State Street, BlackRock, Bank of New York, Northern Trust, BlackRock, JP Morgan. Do you get it? Do you see what goes on here? Let's say Pfizer. Okay, I'm trying to pick different sectors. Here's Pfizer. State Street, BlackRock, Bank of New York, Wellington, Northern Trust, BlackRock again. All right? These are the guys on, when I say they, that's who they are. Those are they. Those guys own trillions of dollars of stocks. The central bank owns trillions of dollars of bonds and stocks and notes and things like that. And these guys are also the bankers. They're the bankers. The Fed is a group of bankers. They're not a government agency. They are a group of bankers. They represent these people. That's what the Fed does. The Fed represents the people who own the stocks. So when you say, what are they afraid of? They're afraid of their stocks going down in price. That's what they're afraid of. They're afraid of people discovering that if it wasn't for money being pumped into the economy at 0% interest, that the actual workings of the economy are not that good. And it's something we don't discuss it because it's difficult to discuss, because it's time consuming, because it's hard to explain to people. But the basic concept is, how much money do you think, or what percentage of the income companies are making is based on the fact that they can borrow money for 3%? That they can sell bonds and pay a 4% rate on a bond, and everybody thinks that's fantastic. So it's, in other words, and these companies are doing this. They're doing it and buying back their own stock with these bonds. I posted that. Where was that? Let's see. It was yesterday. It was today. This morning in member chat, so it had to be like in the end of yesterday's. There. Weekly announced buybacks. Look at this shit. Look at that. $55 billion that week. That's why the market's going up. Not because anybody had good earnings, but because, frankly, because earnings sucked, all these companies, $55 billion this week, $45 billion this week, $35 billion this week. So in the last 3 weeks of earnings, what's 35 plus 45, 70, 80 plus 55, $135 billion of buybacks have been announced in the last 21 days. We've already talked about the fact that, honestly, this is not an exaggerated number. 6 out of $7 that goes into the stock market right now is coming from companies who are buying back their own stock. 6 out of $7. So you look when you're, if you're in a movie theater and you're sitting in a place, right, and there's people in front of you and back of you, look to your left, look to your right, look straight, look behind you. All those people are buying back their own stock. You're the only idiot buying stock, buying their stock. You're the only person, you're the only human being actually putting money into the market. Everything else is the companies buying their own stock. So what are they afraid of? And we had a nice video this morning too. The guy, it was actually chilling. I almost feel like playing that video for you guys today, because it's just, you got to watch it. Forget his name. He was good though. He really had a great explanation for what goes on. Oh, here. Does the government represent the people? I'm not going to play it, but I should show you. Give the guy's name. No, I'm sorry, not that one. Ugh. Damn it. Oh, here it was, Chris Hedges. Sorry, it was this one. That was a good one too, but that's not the one. This is Chris Hedges, The Pathology of the Super Rich. In it, he talks about them. I like to put them in big letters and write quotes around it, but them is a nebulous concept. But like I said, it means those guys, BlackRock, JP Morgan, Goldman Sachs, all the guys who own all the stocks, and they own the central banks. The central banks work for them. They don't work for you. They don't work for our government. They work for them. But the central banks are allowed to borrow on your behalf, you the consumer, you the taxpayer, you the poor son of a bitch. They're allowed to borrow money on your behalf to prop up the, quote, economy, which now means the stock market. Because they're sure as shit not doing anything for the economy. All they're doing is propping up the stock market. They've warped the whole concept of what the central bank is supposed to be for. And all they do now is worry about how much the stock market, if the stock market is up every day, to enrich their members, them. And then them go on TV and tell you they're upgrading this company and they love that company and you should buy this stock and blah, blah, blah. And them advertises on CNBC, and them is Bloomberg. I mean, there's not on Bloomberg. Them is the guy who owns the network. You know, Bloomberg's one of the very few nice billionaires, but he's still one of them. You know, he's still one of them. He's 20th richest guy on earth or something like that. But look at who the advertisers are. It's all these same fund managers, all the same people who own all these stocks are sponsoring the network. So what do you think? The network's going to go on there and tell you stocks suck, or that you should get out of stocks, or don't play, or this economy's got problems? No, everything is freaking awesome. Brought to you by the people who own everything. And they want you to just keep giving them money, keep putting money into their stocks. They're buying their stocks because they have to, because if they don't keep buying their stocks, you're going to realize their earnings are no good. So they need you to help. You know, even though you're only one out of 7 of the buyers in the stock market, they still don't want to lose that 1 out of 7. So they need you to keep buying. Anyway. So I highly recommend, it's like a 20-minute video, The Pathology of the Super Rich. It really is a good video. In fact, I'm going to copy link address, and I'm going to put it in here. I think this will work. Yep. So I recommend that video highly. Where are we? Okay. So, you know, what are they so afraid of? Oh, I'm sorry. Let me, I got sidetracked. Who would think I used straw twice in this? I did a fine for straw. I used straw twice in the same day. So we were talking about what are they afraid of? And I said, look, people who live in brick houses aren't afraid. Every time there's a little fire, every time there's a spark, they douse water on it. In other words, there's only 8 central bankers, a G8. There's only 8 central bankers. And those 8 central bankers control the world. And those 8 central bankers are owned by they're the same BlackRock. Other countries have slightly different rules of their central bank, but really they're all controlled by rich people. It's the same BlackRock and the same JP Morgan and the same everybody who owns every company all over the world. It's the same little 1/1000th of the top 1%. There's 500 guys who control pretty much everything. And you know who some of them are. You know the Cox, the Walton family. You know these people. Some of them have different agendas, but generally their agenda is I want to make more money. There's hardly anybody in that group other than Bill Gates, I think, who says I don't want to make any more money. Bill Gates can't figure out how to give his money away fast enough to stop him from getting richer. That's where Bill Gates is. Bill Gates had Bill Gates had $100 billion. He gave away $50 billion, and now he's got $80 billion. He is really trying hard to not be rich, but it's not working for him so far. God bless that guy, I got to tell you. I really don't know where the world would be if that guy hadn't been giving away $50 billion. It's just an amazing thing. Anyhow, so generally, most of the 1%, it's the top, most of the top 1,000 people in the world, they're billionaires. They want to make another billion next year. They want to make their next billion, their next 100 billion. All they care about is, am I richer than they are? They look at they all care about where they rank on the list and how much more they can have and so on and so forth. It's not about comfort. You know, once you've got $1 billion, comfort is not really an issue. It's a game. Who can accumulate the most money? But unfortunately, the game affects everybody else on the planet. So they, again, which I wrote right here, which is they, are terrified of letting any kind of crack appear in the market because they know it's all bullshit. And I said, people who live in a brick house don't act that way. When there's people who live in a brick house don't freak out if you light a match and throw water on you and take a bucket of water and throw it on you and scream like, put that out, oh my God, because they live in a brick house. And they don't worry about fire. And they know that if it drops on the floor, only a bad accident can cause a real fire, and even a real fire is going to destroy their structure because it's well built. And people who live in a wooden house, that's like a proper wooden house, the wood is, even the wood isn't going to burn if you drop a match on the floor. It's not going to burn the house down. Only people who live in straw houses, where they know that a spark can blow the whole thing to bits, those are the people who freak out if you strike a match. And that's what's going on in this economy right now. You see it all the time. They jump on TV. They talk the market up. They give more money. They put out more free money things every single Monday, basically. There's something going on that pushes the market higher. They push and they push and they push, and that's creating a gigantic, huge bubble because they're terrified of the alternative. But even so, when you keep pushing a bubble like this, and again, they're pushing a bubble because they're scared that if they let it deflate, it's going to collapse. But what they're doing instead is they're pushing the bubble. Same thing they did in 1999, by the way, because in 1999, they knew tech was a house of cards. Nobody thought Yahoo was worth 3,000 times what they earned. But you know what? They still get on TV and they talk it up. And if you ever look at the son of a bitch Blodgett, who still is allowed to live for some reason, would purposely, he knew the stock sucked, and he would get on and talk it up. He's a guy he owns Business Insider now, which is one of the most quoted magazines out there. Everything Business Insider says you see repeated over and over and over again. It's run by Blodgett. The guy's got more power now than he had in 1999 when he was just an analyst. And all he did was he would just talk things up. If you paid him money, he would talk up your stock. So now he does it in a magazine instead of doing it as an analyst. I mean, it's just insane. Anyway, so these guys get on TV, and the people you see on TV, they're the agents of BlackRock and JPM and all the people who own these stocks, and they're telling you to buy stuff. And just like in 1999 where they told you to buy stuff, they're like, oh, don't worry about fundamentals. Jim Cramer was one of those people, by the way. Don't worry about the fundamentals. Don't worry about that. That's the old paradigm. The new paradigm is just buy anything that goes up because it's going to go up some more next week. And it works until it doesn't, and then it explodes, and the whole thing collapses. And when it collapses, you suddenly find, and we just went through this in 2008 also, on also the same kind of bullshit. So it's not like you have an excuse to say, oh my God, it didn't happen in my lifetime. It just happened 7 years ago. There are no buyers. There's no real buyers. Once it turns ugly really fast. And that's why we got very much cashy, because it's just too dangerous to be in this kind of market. And I know it sucks when you see the market going up, and it's annoying that you're not making as much as you think you could if you were all invested. But believe me, when it goes the other way, aside from the fact that it saves you from losing a great deal of money, the opportunities that present themselves when you do have cash and you're the only buyer out there are tremendous. But unfortunately, you have to play a very patient game to do this. All right, and it's tedious and annoying and hard to do, but it's well, we'll see. We'll see if it's rewarding in the long run. But meanwhile, we can amuse ourselves with these little futures plays and stuff and make money while we're waiting. All right, anyway, so that's what the central banks are afraid of. They're afraid this whole house of cards will collapse, but they're so afraid they're creating a bubble that's going to burst. So it's a no-win situation, but it's a question of how far can the bubble stretch before it all blows up in our faces. Jal says on oil, all we need to do is shut down imports and the price of crude goes up. Oh, that's an important thing I need to talk about, actually. If we shut down, well, no, you can't completely shut down imports because there's other, look, again, there are 1,000 billionaires in the world, or there's probably 2,000 billionaires in the world. But there's 1,000 billionaires in the world, let's say, and they don't all have the exact same interest. Some people are selling oil, some people are buying oil. You know, some of them, you know, some guys run businesses that rely on oil. A trucking company billionaire, of course, wants oil to be cheaper. He doesn't want it to be more expensive. So not everybody has the same agenda. So things get to a certain point and there's a little bit of pushback from other powerful people. And that's what your market forces are these days. It's just you can get away with stuff unless you annoy the wrong kind of people, and then all of a sudden the correction takes place. The big thing about imports, though, you're talking about imports. We just approved the 5th person to export liquefied natural gas. That's going to put a big floor under the price of natural gas at about $3, because although I'd say right now it's probably less. Hang on. Yeah, now it's $2.95. Liquefied natural gas is 600 times denser than natural gas. So, you know, you take natural gas, you guys have done this in science, right? You take the gas, you freeze it to like near absolute zero, and it turns into a liquid. And in the liquid form, though, like a balloon full of gas becomes like a teeny tiny drop. You know, so if it's like liquid helium, a balloon full of helium becomes like a little thimble size, not even a thimble, like a pinhead-sized drop of helium at a low temperature. Then when you let the temperature rise, it expands and fills the balloon up. So 600 times, and it's hard to wrap your head around. But when you look at these liquid natural gas storage facilities, right? They build them. And each one they build holds 600 times more gas than a natural gas storage facility. So what does that mean? That means that as they start building these liquid natural gas, aside from the fact that we're going to start exporting our natural gas, which we haven't been doing previously, aside from the fact that the U.S. is going to become the world's largest exporter of natural gas in liquefied form, which is, you know, it's not a good thing. It's not a bad thing, but it's not a good thing either. It's like we're exporting the last of this fossil fuel that we may want to use one day. We're going to start exporting it, but what's the fact of the matter is every time we build one of these terminals, we're sucking up a supply of natural gas and putting it in the ground. That's why the natural gas industry is so big on LNG. They don't give a crap whether it actually gets sold or not. We're going to put a 2-year supply of natural gas in the ground as we fill up these storage facilities. So over the next 5 years, we're going to increase our demand, quote demand, for natural gas by about 30–40% per year, just in the act of filling up these liquefied natural gas terminals. Now, that's going to drive the price of natural gas higher over the next few years, but then there'll be a great shorting opportunity, because what's going to happen is we're not the only country doing this. Every country that has natural gas is planning on being the world's biggest exporter of natural gas. So all that's going to happen is we're putting all this extra storage in the ground. So natural gas might go to like $5 or even $8, you know, over the next 5 years. So natural gas will go up and up in price. But what it's going to do, there'll be two things. First of all, you won't have shortages anymore due to weather. Like a hurricane, if it knocks out production, it won't matter because we're going to have like 6 months worth in the ground. That's not going to be an issue anymore. The storage dynamics are going to change drastically. So for one thing, it'll be harder to disrupt supply of natural gas. For another thing, though, all of a sudden, once you fill up all these storage facilities, then you've got to start selling the stuff. And unfortunately, we're going to run into the same problem. Once we start shipping natural gas all over the world, the market of it's called fungible. The natural gas becomes fungible. In other words, it can be a natural gas. If you make natural gas in Qatar, it affects the price of natural gas in the United States. Currently, that's not the case. Currently, natural gas is a very local thing. So as we create a worldwide market for natural gas that is easily shipped from one place to another, the prices are going to start dropping worldwide. So first we're going to, at the moment we're going to rise closer to like a worldwide number, which is probably about $5 for natural gas. We're going to rise to that. Because of the excess demand of putting all this LNG in storage, we may go up to like $8 for natural gas. But then once we get to 8, and I'm sure it'll spike at some point to a nice number, then we can start shorting it. This is years from now, though. Don't worry about it right now. But once it gets to like a high number, we'll be able to short it, because all that's going to happen is then you reach a new equilibrium, and then you're back to saying, well, we got way too much gas now again. So that's where that's going. That's why it's very important talking about imports and exports. But long term, but the best story about that is, though, that you can, right now UNG is really cheap. We have some somewhere, one of our portfolios. Must be the long-term portfolio. Oh, I thought we had UNG. That's weird. Oh, okay. Well, all we did was sell the 14 puts. So we sold some January 14 puts to start a position. I'm going to want to add a bull call spread to this. So, but basically, UNG is at 14, and you can play that pretty comfortably to be a floor. And I think it's definitely going to go up from here. So when we sell the 14 puts, right now they're about the same price. Well, they're $250. When we sold these puts for $3, so we have a little bit of a profit already, all we're doing is netting in for 11. Now, UNG has a little bit of decay over time. It's not terrible. And the reality is that there's like, I see almost no way natural gas won't be more expensive in 2 years. So it's a really great thing to put in your portfolio and play to move up. It's something that you can comfortably do bull call spreads or whatever you want on those. Craig said, with Nikkei D at 22 and the GDP numbers being released tonight. Oh, yeah, that's why I wanted to be short Nikkei. Thank you. Yeah, Japan's GDP is coming out tonight, and I don't see any way that's going to be encouraging. So the answer is yes, I do. I bravely have 2, and, well, I don't want to be confusing. I have 2, and that's because 2 is small for me. I'm very comfortable having 2, and if I'm wrong, I'm wrong. But I have 2 short Nikkeis, NKDs at 20,200, because I don't see that the GDP is going to convince you that everything is great in Japan. That just is not likely to me. Oh, wait, what's going on here? Ooh, that's tempting. Okay. So we're testing 2130, and we're testing 1255. And how's everybody else doing? The Dow's at 18.3, 21.30, and we're over 45 here. It's very, very tempting to take another short here. Oh, man. All right, well, let's do one and see what happens. All right, I mean, I'm up $4,000. I shouldn't really cry. If it goes to 1260, I absolutely want to be short, so I don't mind if I get burned here on 1 or 2. Let's do 2. Well, no, now it's not going to fill. Oh, there it goes. Okay, now I have 2. So if it goes to 1260, I'm very, very happy to add 2 more, because then I'll have 4 short at 125.750, which I don't mind at all, which is right here. And if it goes up to 1263, I wouldn't mind adding 4 more there, and that would bring me up to about 1260 on the average for 8. And I'm comfortable with that for short. All right, but I'm just still not feeling any kind of major rally or good reason for this. So, but at the moment, I just got 2 short on the Russell and 2 short on the Nikkei at about the level they're at now. And 2, I'd leave overnight. If we go up to 4, I'll be probably wanting to watch it more. Let's see. So, yeah, so like, oh, I'm sorry, he's asking, is it because of the irrationality we're seeing? I don't consider it irrational. That's like all the stuff we were just talking about. I don't consider this irrational. I consider this the rational fear of the interested parties in keeping the bubble going as long as they possibly can. My bet is that it's going to burst at some point. So whether I catch it right or not I don't know, but it's kind of like they say about the lottery, you got to be in it to win it, right? So I just keep trying to take a little poke here and a little poke there, and sometimes, like this morning, you know, we caught a good wave, and I made $1,000 on the S&P, and I made $4,000 on the Russell, because it went up and it spiked up and it made a good short, and then it came down, and then we get out. You know, we take advantage of those little moves. But those aren't the moves I'm looking for. I'm hoping to be in a short position when this thing really collapses, because then it could be some huge, huge money. So, you know, until then, I keep taking a poke and taking a poke and taking a poke. And you guys see it every week. I always want to poke short because I don't care how big the bubble goes. And, you know, again, if you watch a kid blowing a bubble and you bet, oh, my God, that's huge, I'm going to bet against that bubble getting any bigger. Then it gets bigger. You know, rationally, you will still say, maybe I want to bet again then, because I still don't think it'll get bigger. It gets bigger. I bet again. It doesn't get bigger. But when it finally pops, you make all your money back. And the only reason you're going to lose, really, and I understand that, you know, obviously you have to have a decent amount of money to play like this, but you're only going to lose if physics are defied and the kid blows a bubble that's the biggest bubble anyone's ever seen in the history of the universe. So I don't think that's going to happen. But if it does happen, I can afford the loss. That's very important, though. If it happens, I won't be happy about it, but I can afford the loss. It's not going to stop my kids from going to college or something. I'm just going to deal with it. I don't think so, though. I don't think we're going to zoom up to S&P 3000 without a pullback. I'm not saying we're not going to get to S&P 3000. I think we will, because you can't put all this money into the markets and not make the markets go higher at some point. But it's going to be in conjunction with inflation. So we will see some, you know, over the next 10 years, we're going to see some serious growth in the economy. Everything's going to go up and everything's going to inflate, including the market. But in between now and then, there's plenty of room for, like, corrections. And I think we're way overdue for a correction. All right. So Ray says, when the stock price goes down, you want to get in through options, and you want to get in through options. Do you look at options IV before you buy options? And if yes, how low should the IV be? I don't have a thing like that. I mean, we look for, you know, we like stocks. We like to sell volatility. We like to sell premium. So something with a good IV makes us happy as long as we're comfortable that we're at the bottom of the channel that's causing the volatility to go up. All right, so we're not looking for high or low IV. I want to sell as much volatility as possible. I want to be a seller. This is the thing also. We don't buy options. The main thing I teach people is don't buy options, sell options. So we pick a stock we like and we sell a put. The put is us promising to buy the stock at a lower price. So like on UNG, which we were just looking at on the portfolio. So, you know, we enter a lot of positions this way. So when UNG went down on the 17th, and let's take a look, we'll figure out what it actually did. UNG. Okay. So here's April 17th. No, was it May 17th? When did we do that? Got to be April, right? UNG, April 17th, right, okay. So on April 17th, right around here, there it is. See, UNG came down. So UNG had been 13.49. It bumped down here to under 13. And what we did when it was now, keep in mind, it was under 13. What did we do? We sold the $14 puts. These puts, $14 puts, we sold them for $3. Even though those puts were in the money, we felt strongly enough that UNG should be going higher that we were like, I want to sell as high a put as I can stand. I want to sell as much premium as I can possibly stand. So we jumped on taking advantage of the move down and the higher volatility. Now, it went the other way, of course, for a bit. So I wish we had known, you know, it would have been nice if we caught that, but we didn't. So at this point, though, we sold the $14 puts for $3. That nets us in at $11. So I don't care whether we're up or down in this channel or whatever. All I care about is I'm at net 11. As long as it's over 11, I'm perfectly happy. That's a great way to enter a position, right? So I want my IV to be high. I want the volatility to be high because I want to sell as much premium as I can. That makes it cheaper for me. I sold the $14 put for $3. Now the $14 puts are $2.50, which is actually still a good price considering it's up another $1 from where we went in, or more than $1. It's up $1.50 from where we went in. And that's what so, you know, it depends. But basically, you know, we're trying to just generally sell premium, not buy it. And if you always keep that in mind, it's good. Josh says, when does the Yellen stupidity end? It doesn't end, but how can it end? She's appointed, though she's technically appointed by the president, the actual central bank, the presidents and the governors of the central banks are appointed by the bankers, by the guys who own all those stocks, J.P. Morgan, BlackRock, blah, blah, blah. They appoint everybody. So Obama's picking from the 10 people or 12 from the 12 governors that have been appointed by the bankers. Obama gets to pick one of them to be the head of the Fed. That's how it works. It's a choice of, out of all these bankers that have already been picked, you get to pick one to be the guy you're going to be as your liaison. It's still, she totally works for the banks, and the stupidity doesn't end until they've gotten out and they've sold enough stock, or not just gotten out though, because don't forget, another reason they want the VIX to be low is because they can buy puts on the S&P. And so in other words, there's a lot of people who think they're smart who are buying calls on the S&P, and so they think the market's going to go up forever. We just did a play where we bought calls on the S&P. There was a top trade yesterday. So we're one of those idiots. But the point is, if the market's going to keep going up forever, then yeah, I want to be protected against insanity, and I want to have some S&P longs. But these bankers, and we're not the only ones. I mean, anybody in cash, you want to have a long on the S&P to protect your cash in case the market keeps going up and your cash becomes worth less. So there's lots of people buying SPY calls, and effectively that's the same thing as selling a put on SPY. So these guys are buying puts on the SPY, the guys who own all these huge stocks. So when they are full of puts, when they have enough puts that they don't mind if the market goes down, they give the word, and all the trap doors are pulled and the market collapses. And they'll blame it on a fat finger. They'll blame it on something. They'll blame it on something. You know, they'll use an excuse to say this is why the market crashed. It wasn't because we all had a meeting at the Pines in New Jersey. There's a golf course in New Jersey where these guys go to get together because it's off the grid. So they're not going to tell you that they had a meeting at the Pines in New Jersey and they all got together and agreed, or when they have the Bilderberg conference coming up, they don't say they had this little private room which they know is free of bugs and surveillance devices and whatever, and they get together and they say, okay, we're all going to drop the market on April 21st. As like, or not, they won't say, they wouldn't do it on April 21st. They say around April 21st, we're going to find an excuse. That's how they do it. And so if there's whatever news happens around April 24th that they can blow out of proportion, they'll do it. And then all of a sudden, boom, everything falls down. So they pick a date when they're all comfortable in their short positions, and that's how the market ends up dropping. So that's when the stupidity ends. It's not stupidity at all. It's genius. Because what they're going to do is they're going to let the market drop. They've got all their puts lined up, which they bought at incredibly low VIX prices, right, on low volatility. Those puts shoot up in value, offsetting their losses. They then cash in those puts at high volatility when they know the bottom is there. And how do you know the bottom is there? Because you're the one that caused it. Of course you know when the bottom is there. When you're the one causing the bottom, you know when the bottom is going to end. And then they get, so once they've driven all the retail people, all the guys that they're herding into the stocks now, once they herd them out of the stocks, when Kramer tells you, get out, run away, the market's crashing, it's a disaster. Once that happens and everybody's out and all the suckers have cleared out, then these guys flip around and start buying stuff. And they start buying all the stocks that everybody's abandoning. And they build up their positions higher. And that's why you see the same 10 names over and over and over again on every single stock. They bought them all last time. And all they're doing now is increasing their position. You know, and it's a horrible thing. It's terrible that the world works this way. But on the other hand, we you know, it's easy enough to see where we can play along with these guys. What's the solution to the pathology of the super rich? Oh, that's a long one. I could give a whole week-long lecture on that. The solution to the pathology of the super rich, as the guy, I cannot get his name right, as the guy in the video is saying, though, the only solution is really revolution, though. You know what they're too greedy. They're cutting off the options, the pressure releases that he was talking about in the video. He's saying that you used to have pressure releases. In fact, I just watched, oh, it was so good, the Roosevelts. It was like a Ken Burns thing of the Roosevelts or something on PBS. It was so good. It was like 7 parts, 14 hours, going from Teddy to Franklin. What a time of the world. I mean, back in 1900, you know, a little early 1900s, all the way to through the war. As told from the perspective of this family, and not in a bullshit way, like a documentary, but these guys were essentially the Bill Gates of their time. I mean, these guys they were part of the super rich, but they also had this sort of they fought for the common man, and they made changes and they pushed through. If it wasn't for Roosevelt, because J.P. Morgan hated Roosevelt, hated him. He was his enemy because Roosevelt was what they called a trust buster. He was one of the top 1%. They didn't understand why he would do such a thing to them, and he thought that these trusts that ran everything were evil. And they had these trusts that would own everything, which is essentially what we have now. When I was just showing you those stocks, those are trusts. All the people who has their money in BlackRock and J.P. Morgan and stuff, the same 1,000 rich people have their money in these things. And those trusts own everything else. And they use their ownership of everything to create monopolies and to create industries and so on and so forth. It's horrible. In fact, John Oliver did a thing on his show last week, tonight, this week. John Oliver had a thing on the chicken industry. That was disgusting. But that's a trust. Because companies, there's 2 or 3 companies that control everything, and they set up a system in which the chicken farmers are essentially slaves. And they do everything that this company wants done the way the company wants it done, and if they give them any crap, they punish them. And they punish them by controlling their supply chain. And they can cut off their supply of feed, they can cut off their supply of new chickens, they can do anything they want to these farmers, and it's under contract, and if they raise a peep of complaint, they're destroyed by these companies. And that's how chicken gets to your plate in the United States. It's a horrible, horrible business to be in. That's what a trust is. That's what the whole country used to be, trusts before Roosevelt. And he broke those trusts. He pushed through. We had some anti-monopoly stuff, but it was never enforced. He started enforcing anti-monopoly legislation. That's why it's called the Sherman Antitrust Act. Trusts were what effectively became monopolies. So if it wasn't for guys like that, which are what the guy in the video is talking about as pressure release valves. If you don't have those pressure release valves, if you don't have every once in a while a little union uprising that helps the workers out, if you keep crushing and crushing and crushing the bottom 90% until they're so desperate they have nowhere else to go, you create the revolution in the country. You create the acts of violence, you create the strikes, you create the violence, because you're giving people no escape. You create Baltimore. People are freaking fed up, and this whole country is going to explode at some point. And it's hard for us. I mean, we are the investor class. We're the top 1%. And we don't realize it, but the top 0.001% are our enemies. It's hard to realize that, though, because we live lives of relative comfort. But it's bad. If you're in the bottom part of this, if you're in the bottom 80% of this country, you're in bad shape. It really is not good, and it's not getting better. It's only getting better for us because our stocks are getting better. But most people in this country are struggling really hard to get by. They're going further and further into debt. It's a very nasty situation. And at some point, it's going to hit the fan. All right? So let's try to make some money before it does. That's all I can say. What do I think of PVA now? I don't know. What do I think of PVA? I mean, why would I think of PVA? It's a very, very random thing. Let's see. How are they doing? Why are you saying 80? Oh, you're specifically asking about the January 4. I honestly, I couldn't tell you. You have to ask me in chat because I had to research it. I mean, it's not something we usually trade. There's a lot of these guys, and I'm not really sure if they're good for a turnaround. I think this may be reflective of their real prospects. I'm not sure I would play them 4 pounds. And again, we do not. We teach people this all the time, so you're probably not a member, Ray. Don't buy calls to bet on stocks. Don't be the sucker that pays the premium. If you want to play it, there are much better ways to play it. I don't even know if it's playable though. But honestly, that's the worst way to play it because you're going to pay 80 cents for the $6 call. That means you don't make a dime until it's at $6.80. It's at $5 now. You need a $1.80 gain. You need a 30% run in the stock just to get even. The odds of winning on that, you're just handing. We love people like you. You're the guy who pays us. We'll sell that every day. Because basically, unless the stock goes up 30%, you don't make a dime. So we'll buy the stock, and we'll sell you that for 80 because you know what? 80 cents is 20% of what we paid for the stock. So we make 20% no matter what. And all you get to do is buy the stock from us for 6, which is another 20% up. So by selling you a $6 call, when we buy the stock at $5, we make, in order for you to make a penny, we make 40% before you make your first penny. So which side of the table do you want to be on? It's a terrible, terrible, awful way to play anything. So the worst possible use of options is doing trades like that. Chrissy says, why is BNO so much lower than CL? Look, BNO is Europe and CL is here, and right now we've got the contracts rolling over, so God knows what's going on. I don't think BNO is that low, though. What are you talking about? Let me see. Oh, BNO is down 3.3%, and CL is down 3.75%. So no, they're moving pretty much together like they usually do. But you know, you have to realize they're independent markets to some extent. They're going to eventually more or less line up over time, but at any given day, it could go either way. Ray says, Phil, do you like selling 2017 puts and bull call spread on SPXL rather than SPY? No. I like SPY because it's liquid. All right, you're going to get the same. It works out the same either way as far as margin, as far as how much you're going to have to put in, as far as your leverage. It's all the same. SPY is just more liquid, and I'd rather be in the more liquid instrument. Any thoughts on SDS, shorting the S&P in the next few months? We did short SDS. We've got in our short-term portfolio, but then we just talk about it. We've had a whole conversation about this. In the short-term portfolio, this is the SDSs. As I said, we're not ready to roll yet, right? We have the June 20 calls. All right, and here's a case where we did buy the calls, but we bought these calls because the short-term portfolio, which is, what's that? $205,000, okay? It's up about 100% so far. So the short-term portfolio, though, but the main function of the short-term portfolio is to protect the long-term portfolio. And the long-term portfolio is $770,000. Oh, I'm sorry, $750,000. So the long-term portfolio's got $770,000 in cash. The long-term portfolio is $750,000. We're using the short-term portfolio to protect it. So the only reason we're taking that play that I just told whoever just never to do that, we're doing it on the S&P because it only costs us like $8,000 to protect our $700,000 position here. So yeah, I'm going to take 1% of this money and use it to make sure that between now and June I don't lose money in this portfolio. That's the purpose of that. But even so, we don't want to lose it, so we're talking about rolling it and hedging it and so on and so forth to make a longer-term insurance play out of it. Chrissy says, can we discuss yesterday's SPY trade? Yes, I can. Here we go. Control F, and we'll look for SPY. SPY. Here we go. All right, what was the SPY trade yesterday? Okay. So we talked about SPY, and we were talking, this was in the context of the conversation, and we were talking about if you just had $1 million and you just wanted to play mostly SPY, what would you do? And I said I'd take about $300,000 of the money. So we were talking, this is in the context of yesterday's article where I said how, you may as well just put your money in the S&P and ignore these idiot managers and blah, 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 and why are you paying these guys a commission when all you got to do is just buy SPY? So that's where this conversation came from. So I said, I take about a third of the money to make sure you're pretty well indexed to the S&P in your portfolio. So at $1 million portfolio, I'd buy 30, this is a proportion, 30 of these 2017 200-230 bull call spreads. At the time, those were 14. They shot up a lot, and I'm sure they're still up because we didn't really move on the S&P yet. So they're up to like 16 now already. The 200-230 bull call spreads for $14, and I would sell 25 of the 170 puts for $8. So that's 42,000 minus 20,000 is netting you $22,000. So you're spending $22,000. You got $1 million, and you're going to spend $22,000 for this spread. Now, how much if the S&P, 230 on SPY is 2,300 on the S&P, up 50%. We're in the money already, though. Don't forget that also. The S&P is at SPY's at 213. All right, so 213 would pay you $13 times 30, which is what, 39, right? So of the 42,000 you're spending here, 39,000 is already in the money at 213 on SPY. You only have to get to 230, which is up another, not that far, not much more, but another 10% from where we are now to get to 230. So it's not 50%. I'm sorry, I was being conservative on this one. I apologize. This was a much more conservative play. We're just looking for a 10% move in the S&P on this one. It was the one below those 50. So looking for a 10% move in the S&P, you get 30 of these at net 22,000. 30 of these at 230 on the S&P are going to pay $90,000 back. So you're going to get a $68,000 profit, 300% on that spread alone. All right, and like I said already, this spread jumped $7,000 yesterday. So the net 22 went to 29. That's in one day. So what's 9 out of 22? I don't know. It's a good number. It's like 40% profit or something like that. So we made 40% yesterday. That's a pretty good start. But again, don't forget your goal is to make 600%, or 300%. So 40% one day is on the way to your 300% goal. It's not like it sounds phenomenal, but really that's what we planned on. So I'm talking about it here, and it uses just 43,000 in margin to make that trade. All right. So if you make your 68,000 out of $1 million, that's 6.8%, right? So there you go. That's already on just a small little allocation of your money. You're going to make 6.8% of your total portfolio, of your $1 million portfolio. That's fantastic, right? Now, I said now, if you're worried the S&P is going to go much better than that, then I said, what do we talk about getting? Oh, if you're worried about missing out on a huge run, so you say, okay, well, it's nice to make 6 point something percent on the S&P, but that's only going to give me like an inline return. But what if the S&P shoots up 50% like it did over the last 2 years? So I said, if you're worried about missing out on a huge run, then what I would do is I would add 15 of the 2017 240 calls for $480. That's $7,200, and I would offset that with the sale of something you really want to own that's $7,200 or around there, like 10 Apple 100 puts. So what does 10 Apple 100 puts do? It makes you buy Apple 400, 1,000 shares of Apple 400. So I've got my $1 million portfolio, and I'm saying I'm willing to buy $100,000 worth of Apple if it drops to $100. Well, of course I am. Do I want Apple to be 10% of my portfolio if it drops to $100? Yes, I absolutely do. So that's all I'm doing. So this is essentially free money because I'm perfectly willing to execute that trade. So I take that money, I buy the much more aggressive calls, and I said, or you can add some more SPY puts or whatever. It doesn't matter what you do. But the point is to make this a low-cost or no-cost trade. Now, when you run this one in conjunction with the other one stops paying you at 230, right? This one starts paying you at 240. But anything over 240, you make all the money. So at 240, since now again, remember, and I'm saying $1 million, you divide by 10. If you have 100,000, you divide by 10. If you have less than 100,000, you shouldn't even be doing this stuff. But if you have 100,000, you just divide all these numbers by 10, and that's the way you play it. So on $1 million, though, the idea is to have 15 of these calls. Now, 15 calls doesn't sound like a lot, but if we take out Mr. Magic Calculator here, and we say 15 calls is 1,500 shares, and if SPY goes from 240 to 300, which would be S&P 3000, that's going to be a $60 gain, and that's $90,000 more dollars. Is that right? That puts you in for net 800. I think I did the math wrong here. But anyway, so it's another $90,000, so another 10% on that, just for doing that little trade. Why did they come up with that number? 240 to 300 is 60, and 60 times 1,500 is 90,000. Yeah, it's 90,000. It's half that. 45,000 gets you back 45,000 on that. So that's the way, that's how you can sit there and hedge yourself against a very large S&P run for very, very little money. All right, and in fact, today, let's see these 2017 240 calls. Let's see what those are now. $240, now they're $520 was the last price on those. All right, and yesterday they were $480, so they went up 40 cents. So they went up 10% in a day since we were talking about them. And that's the kind of moves you get with this stuff. All right, Ray says, Phil, you're in the Hall of Fame right besides Gates and Buffett exposing the truth and giving money away. Oh, thanks. Chrissy says, chickens work the same as Monsanto. Yeah, Monsanto's another evil corporation. There's lots of them, though. That's the thing. And it's funny because it just reminded me, when I'm watching that show, The Roosevelts, it was so, so good. It really was. If you like that kind of documentary stuff, it was amazingly well done. It just reminded me that, like, yeah, it is the same thing. These are trusts. They just change the name and we act like it's okay. But there's no difference in the way they act as the way these trusts acted in the 1900s, and these trusts would force children to work in the mines and blah blah blah, and people would work 80-hour weeks, and they would get no. And if the miner got injured on the job, they would just cut. They'd just be like, okay, you're fired. You can't work in the mine anymore because you got hurt. There was no compensation. There was no sick leave. Nothing. In fact, a miner would be working in a company. Here's how it works in the mines. Because you're in the middle of nowhere, with these mines. And it's like the people who live in the oil towns now. And in fact, that's the point. It is exactly like the people who live in oil towns now in North Dakota and stuff. The oil company builds a town. You work in the town. You buy your house from the oil company. You rent it from the oil company. So you're working for them, but then they charge you a profitable amount of money to live in the house that they get you. You go to the store that they own to buy your stuff at ridiculous prices. It's almost comical, all right? And then, but the only difference now is if they fire you, there may be some kind of severance or there may be some kind of health care involved if they fire you. But in the old days, that's what a trust used to do. They would have these people who worked in factories. They worked in a factory town or a mining town or whatever, and the company would own everything in the town. And so the workers, no matter how much they earned, it would all go back to the company. And in the old days, though, if you stopped working, they would immediately foreclose on the house, kick you out, and throw you on the streets and say you're a bum, you don't work. I mean, even if you worked for the company for 40 years and then got hurt or had to retire or whatever, or got too sick to work, that was the end. You were done. It's almost the same now. It really hasn't changed that much. And it's just so amazingly sickening. That chicken thing on the, I forgot to put that on the site. I got to put that up. The last week tonight with John Oliver, and you just put John Oliver and chickens in Google. It's like horrible. Anyway, oh, wow, 2:20 already. Holy crap. Twitter. Well, Twitter's shooting up. Yeah, my thoughts are that we were long on Twitter, and now Twitter's going up, which means we are geniuses. That's all. It's not complicated. It was too low. We don't, by the way, we don't usually do that. In Twitter, because it got so low, we sold the puts. And again, this is the best way to enter a trade. Twitter on 4/29, which was right after earnings. Let's find Twitter. We read the earnings. See, when there were earnings on 4/20, this is what's great about being in cash. Tyson, well, I hate him, so yeah, I'd say cash out. I think that wasn't it's not one of our portfolios, I don't think. It's just a trade I called out. And again, that was an earnings trade. After watching that John Oliver thing, I really hate Tyson again. They creep me out as a company. So Twitter had a crash. Because we're in cash, we don't give a shit what happens. We just look and pick up the pieces. We read the report, and on probably jumped the gun. I mean, it was on the 29th, we gave, oh, look, there's good restraint. We gave it a day, right? So the earnings were here, and probably here is where we bought it. We decided, at this point, we said, oh, that's low enough, and we figured that was a good place to make a stand. But what stand do we make? Well, in the long-term portfolio, with Twitter at 38 bucks after having a horrible crash, we read the report and said, that's not so bad. And what we did is we sold the 33 puts. Now remember, Twitter's at 38. We sold, because of the high volatility, we sold the 33 puts here in 2017, which is around here. And all Twitter has to do is not be lower than this 2 years from now, and we're going to make all the money that we sold. So we sold those puts for $470. We collect $4,700. And the only thing we're saying is if Twitter is below 33 in 2017 in January, we'll buy it. That's all we're doing. We're promising to buy it if it's lower. Oh, wait, look at that. Wow. Okay, so if you want to play, these are actually more expensive now still than they were when we sold them. So I heartily endorse that trade. Now, we like that so much in Twitter that in the short-term portfolio, we actually took a more aggressive position, which was this one. We bought the January 38.45 bull call spread. We bought that for a net of 210, and then we sold the 35 puts for 320. So 210 minus 320 is what, $1.10. So for net of $1.10 credit below 35, so that would net us in. So we're effectively promising to net into Twitter for $33.90. So for a net of $1.10 credit, we have a $7 Twitter spread. So we could make up to $7 plus $1.10 credit is $8.10. So we can make $8.10 on this trade. Times 5 is like about $4,000 we can make on the on this trade. This trade also is still available. In fact, it looks like it's almost exactly the same price. These two guys evened out, and this one is down a bit, so you can actually get a little bit of better entry than we had on Twitter. So yeah, I definitely endorse that trade. I think it was just overdone. All right, and last one that we got to do, and then I got to keep going, or last couple anyway. Craig says, Apple, Wall Street Journal says they're scrapping the TV set. Yeah, but that was never, the only reason the TV set was even a thing is because Icon started talking about it. I mean, we thought Apple was going to do something with TV, but it wasn't necessarily an Apple TV set that everybody was expecting. It wasn't baked into the price. So that's why nothing's happening. There's really nothing going on. It's just like the vaporware turned into vapor. No big deal. And Apple scrapped the TV set because the margins aren't there in the TV. Apple does not put out a product unless it can get a 35% profit margin. They will stop making a product if it can't get 35% profit margins. There's nothing more important in their company than can we make at least 35% on what we sell. That's why they're such a great company. They'll make anything, but they got to make 35%. That's why there won't be an Apple cart. You can't make 35% on a cart. There will never be an Apple cart, but there will be Apple components in a cart. That's where you make the money. So probably what you're going to see is going to be Appleized versions of cars. So it'll be like a package you buy, the Apple Upgrade package, and it'll be all Apple themey desktop stuff inside your car. You know, that's what's going to happen down the road. They're not going to make a car. Cars are crappy margins. They want to make the stuff. Stuff has great margins. You know, and that goes to TVs too. TVs are a terrible margin business. Doesn't matter how good you make a TV. As Apple is learning with Samsung right now, it doesn't matter how good you make your stuff, somebody's going to knock it off. And with TVs, the overall investment and the production and blah blah blah, it's not like small stuff. It's like it's too much hassle, and you're just going to end up getting burned on margin. And they don't get burned on margin. That's one thing. After Jobs died, they kept up that was the most important thing I was looking for after Jobs died, was, are they going to stick to that philosophy? Because that philosophy is what really drives the company. Don't sell low margin crap. You know, if it wasn't so evil sounding, it would probably be their corporate motto. Any call on oil with the price down today? No, I think oil's where it deserves to be. I mean, you know, the contract's rolling over, and probably what's happening? Wait, sorry. See, we're getting rejected at these places where I wanted to go short. That's good. I forget I have bets on sometimes. All right, nowhere. Look at nowhere. How did it go nowhere the entire time we're talking? How's this guy doing? Oh, he's up a little bit. He's up $100. Fantastic. All right, see, love that stuff. See that? Don't complain. This seminar, see, I mean, if you guys would have followed me right there, $100 profit already. Very nice. Close it out. Then you made $100 by talking to me. That's worth it. So Mylan, time again. Yeah, we did Mylan. Mylan's in one of our portfolios, isn't it? Mylan. Yeah, there it is. See? In the long-term portfolio, in Mylan, we took the 65.75 bull call spread, and we sold the $60 puts. And that one came out at, let's see, that's 12, so about 225 net on that one. So yes, it was time to get in on 421. We liked it. And still, look, see, we're losing money on paper, of course, but you can still get in for what we paid. So it's still a good trade. I endorse it. All righty, so things are going our way as far as the futures go. I'm sticking in this because I'm hoping for a much bigger correction than that. But I also already made a ton of money. But if I was like you guys and I just came in for a seminar and I took that trade and made $100 in 10 minutes, I would take the money and run. Just because you never know what's going to happen in this insane market. But I'm in this position for to watch what happens for the next few days and see if we can get a nice. I want to see it drop back to 1240, which will make me what, like $3,000 bucks. So that's what I'm in it for. All right, and that is the end of the show for this week. We will check back with you guys next week. Oh wait, Monday's a holiday. I think we can still do Tuesday though. Okay, we'll still do Tuesday next week. Okay, so let's call it same time, same place next week, and we'll all be back. And everybody have yourselves a wonderful holiday weekend. Okay. All right, take care, all.